What up, guys? Um, so this video is going to be part of a kind of new mini series that I'm making, where we're going to talk about how to time the bottom of a huge stock market crash. Because I think if you think there's going to be some kind of Great Depression, or you think there's going to be a huge stock market crash, and you're really trying to figure out when you want to get back into the market, it's good to start thinking about this now and really developing that strategy now. So that's kind of what we're going to talk about today. I'm going to talk about one indicator today that held as support for last 50 years. It has over 100 years of data when you look at the Dow Jones, and you're looking over the monthly time frame. So there's a lot of information we can get from it. So that's why I really wanted to talk about it today. Before I continue, not financial advice. Please do your own due diligence before making any type of financial decision. Past performance is not an indicator of future performance, so research. I'm not a financial advisor. I don't pretend to be. Consult with a real advisor for investment advice. I'm simply trying to, piece together this puzzle just like everyone else, and I'm just sharing what I have, and you can make whatever inference you want from it. Just do your own research, all right? So diving straight into it, this is the 300-month moving average. So take this moving average, put it in your toolbox, tuck it away, and just think about when you're gonna need this one day, and you want to start developing your strategy now to timing the bottom of a bear market. And there's a lot of other strategies too that you could combine with it. Just dollar cost averaging into a market is a great strategy. All right, you just slowly average your way in, because eventually, the stocks, they might stagnate for a while, or something else can happen, or it's an extended bear market, but you can be in good position long term. And building long term wealth, that's the name of the game. You just kind of buy while things are low, you stay patient, you hold it, and eventually you're right, because anyone who's buying, whether you bought the bottom or you're buying here, you saw pretty cool gains over the years if you're patient enough. So patience is the name of the game, but bottoming this market, all right? So this moving average, the 300-month moving average, actually served as the exact bottom in 2009. So if you bought right at the 300-month moving average, then you timed the bottom. Congratulations. But looking back over the history of the Dow Jones, we saw that the last time it touched it in 1982 held as support, and then it really started to take off. 1980 did it, 1978. In 1974 it was a little choppy, but for the most part it just held up. Now it gets kind of interesting when you go back towards the 30s and the 40s and this Great Depression era, and that's why it's something you put in your toolbox, but it doesn't give you all the answers, lo and behold. So when we look at the 1930s period, we saw that we went under, and it wasn't just you spiked 20% below it and we popped back up. It was from 110 to 140 or to 40. Sorry, it was from like 110 to 40. So over 60% spike down, and it's not really helpful to want to time the market here, buy at this average, and only for it to go back down another 60%. But it is what it is. It happened because the Great Depression was a huge crash, and if we're going into another Great Depression 2.0, or a huge stock market crash where we just have massive defaults and bankruptcies across the board, because let's face it, banking system is not well equipped to handle something like this. They don't understand the system well enough. They're kind of helpless, and they've kind of shown that throughout the years, because they don't know what to do aside from QE and lowering interest rates. And yet we still have these problems. And that's a story for another day, but just, to focus on the indicator at hand. During the Great Depression, I think one thing that was kind of important was, and this is something we want to keep our eyes on, our eyes open for, is on the monthly, what happened was, we had this huge capitulation candle, and theoretically, when you get a capitulation candle like this, you usually form some sort of bottom, and there's a bounce, and it's possible we do that. But what happened was we had a monthly close below this 300 month moving average. Also, just keep in mind that you have to use Japanese candlesticks so you can note the opens and closes of each month for this moving average to really be effective in the way that we're analyzing it here. But the following month, what happened was we had a green candle, but the close was not above the 300 month moving average. And that was kind of a signal that maybe this isn't going to work, or maybe next month is going to be bad before maybe the month after is just green, right? So we weren't really too sure at that point. And then the next month, what happened was we spiked over. So it's like, oh, this is the candle, this capitulation. But if you waited till the monthly close, yes, it could have closed up here and you could have started scaling in with a little more confidence that it was a bottom, or, you finished down below and this ended up finishing below this green candle. So that kind of was the indicator that it's probably going to go a little lower. And from there on, once you're under this 300 month moving average, you can't really do much to time the market. That's where you want to turn to another indicator, maybe like a 13-week moving average, or you look for this pattern. I think what was really cool about the Great Depression was it formed this wedge where the price squeezed and buyers would step in here, sellers would step in here until one of them just got, they just gave up and they just let the price go. And kind of like that monthly indicator there, I actually drew this wedge on a weekly scale. So to see the, it kind of break out right there, and this wedge pretty much to the end of its road would have kind of told you that it was most likely breaking out there. So you could look for other signals to kind of time the bottom there, but this 300 month is going to be important. What price does at this 300 month is going to be very important. Wouldn't be surprised if we do spike down, we do see like further downside to the stock market. I'm really not sure, so we're going to play it by ear. But in the following years, it was a little choppy. So from the 1930s, really after this Great Depression, all the way to, World War II, what we saw is we went up and then we hit the top in 1937. And mind you, the 1937 top was right at the bottom of the first wave down. So that would be equivalent to the Dow Jones crashing, 60, 70, 80%, whatever, it could be 40, 50, but it crashing, and then over the years it recovers to the bottom in March 2020, so the coronavirus pandemic. I thought that was kind of interesting how the top was actually that bottom point. The top in 1937, before we went to that huge recession, was the bottom in that first wave down of the Great Depression, which would be equivalent to the March liquidation crisis. And then, but from that top, we kind of went under again. We capitulated under, and then we started having closes. And from this point, it was just a very choppy period. It was unhelpful. But the real point of the video was, and then it eventually held as support after World War II. But it kind of went up, it went below it during the war. Didn't do very well. Found a bottoming point. And you're just gonna have to use other indicators to figure out where you want to buy at that point. But the real point of this moving average is, it's possible that like 2008 we bounce and then we move up, or it's possible that like in the 1930s we go a lot lower. It's going to be important to watch what we do right at that candle. We could even see a little relief and then boom, we could fall down. But you got strategies like dollar cost averaging in using other technical signals like another moving average. You look for bottoming patterns like a capitulation and a head and shoulders at the bottom, or something like you see a bottom here, and really your next opportunity to buy would be close to that double bottom here. You could just start scaling in. Even when it goes up, you just start scaling in. You could just start scaling in right here. Even if you're scaling in 31, by 33 you break even. I know it's not ideal, but when you're playing stocks for the long game, eventually that serves as like kind of like a major bottom, and we do see that again, 38. But that's the name of the game. We actually went lower. But it could be choppy, but long-term capital gains, we're gonna see high taxes. I mean, you're just gonna want to buy stocks and sit in them. That's a strategy. You just slowly buy your way in. But yeah, that's it for today, guys. What do you guys think? Leave a comment down below, like and subscribe if you like the content, and we'll see you in the next video. This was the first video to time in the bottom of a Great Depression, so stay tuned for the next video. You guys have a good one.